All
Hello
right.
and welcome to the Real Estate Macro Podcast. My name is Douglas Dow, and joining me today is my good friend Andrew Rosenberg. Andrew, how are you?
Wonderful, Douglas. So happy to be here. Such a thrill to be on the show, and congratulations on the new show.
Thank you so much. I am excited to delve into several topics today. And just to let everyone know, the thesis of my podcast is to delve into several things: economics, macroeconomics, especially, and risk. Andrew is a connoisseur of all of the above, and I look forward to getting his perspective. And Andrew, could you give us a little bit overview? How did you get involved in real estate investing and investing generally?
Oh, okay, great. I'm gonna go back a little bit further. So, like, my background's a little different than most people. As early as I can remember, when my grandfather would visit, I would sit on his lap and read him the daily stock page from the newspaper. There for the younger viewers, there was a day when the internet didn't exist, and you would actually get your quotes off a newspaper. Day trading really wasn't too popular back then, a little harder. And he wanted to know the volume and the P, and I would learn about all these things. And I really loved it. I liked it as from an early kid. I was hearing about zero coupon bonds and the Hunt brothers trying to corner silver. And my bedtime stories weren't Little Red Riding Hood. My little my bedtime stories were like junk bonds and Michael Milken.
Blue
That's
Horseshoe loves
yeah,
Gray
my
Star
my
Airlines.
father would come up from his office and get really mad because I'd steal his Wall Street Journal out of the mailbox, and I was reading it as a little boy, and I'd read.
That's
This is
awesome.
when Fortune and Forbes were
Right,
actual business publications that were well written.
right.
I wouldn't read them anymore. I mean, to be honest, right now they would only be lining for like kitty litter box. Um, so then, flash forward a little bit older. I'm starting to read books like A Random Walk Down Wall Street, Against the Gods, The Remarkable Story of Risk. And my friends are looking at me like, okay, we're reading comic books. You're reading these books. You're a little weird, but okay, you can still hang out with us. 13 years old, I'm Jewish, and we have a bar mitzvah. And six ladies from my grandparents' little small town pool up their money, write a check, send in the card, mazel tov on your bar mitzvah. But there's a catch. Um, you have to invest this money in a stock as an education.
Mm.
Their point of view is it's all nice and good to read and be theoretical, but it's a little different when it's your money. So I said, okay, and my father set up an account, and I had to trade through him, and he had to phone call the orders in. And the very first stock we bought was Smucker's Jams and Jelly. I'm a conservative guy. I like my dividends. The PE was historically low at the time. They're going through a transition. And about 6 months later, stock goes from 60 to 80. I sold, took my 20 points, and then began, I wouldn't say a love affair, but a long term hobby of occasionally buying small amounts of stocks. Never, nothing large, never large, mutual funds in your IRA or whatever, little game, but it was always a fun dabble. Then I went off to business college, little school called Babson, and it was easy. My first accounting class, people were going nuts with, how do I calculate return on equity or debt to equity, ratios. And I'm thinking, geez, I've been doing this since I was like 13.
Yeah.
This is all very familiar to me. They had a little sheet, and it was, here's your code, all your little ratios and formulas. And I'm like, I don't need these formulas. I know what the return on income. It's pretty obvious, return on assets, income divided by assets. You don't even need a cheat sheet. And I went to school with some really brilliant guys. One guy became a math a professor of finance, and he's very heavily involved in statistics. And
Mm.
the guy's brilliant. I'm not that smart, but when you've been doing this long enough, so for me, that I'm 47, so that's 34 years, plus. We've seen this movie before. We've seen markets go up and down. I lived through very specifically the tech bubble and boom. We've seen the GFC. Um, there'll be another bubble again. There'll be another. I mean, we're probably on the burst of the bubble now. They come, they go. They don't really scare me or involve me. I find it amusing. I call it fear porn, and I write a lot of
Yes.
um, probably somewhat obnoxious LinkedIn posts. And people say I'm a little bit out there or a little in your face, and I don't mean to be. I'm actually honestly to be honest, I generally tone my posts down, frankly, and edit quite a few down and delete quite a few. Because to be honest with you, CNBC, Bloomberg, name the channel or publication. It's just noise and entertainment to me. It's two sides of the same absurd coin. I could care less what some YouTube personality living in mom's basement whose net worth is less than what I spent on a weekend to entertain my family
Right.
has about the stock market. I
Right.
mean, it's just utterly comical. I mean, I don't really.
Even funnier. I don't know if you saw this. We were just cracking up this weekend about the inverse Jim Cramer ETF, and we
Yes, yes,
lost
yes.
it. We were rolling. We thought that was the funniest thing we've seen in a long time.
Yeah, the inverse Kathy Wood. That's another one I quite enjoy. Um, you know, it's funny how arrogant we can be. That expression, it's different this time.
Mm.
I'm going to go with Warren Buffett. I remember very specifically when his returns were flattening out, she's on her little meteoric rise. And then, try to be polite here, the interesting folks come out and say, Warren's lost it. The world's changed. Kathy knows disruption. And I'm thinking, okay, we don't measure the world in quarters or weeks or months. I know what reversion to mean means. I've lived through the dot-com bubble. I've seen this before. And sure enough, she's a little bit knocked off her pedestal. And I make fun of her a lot, and I'm kind of mean to her, but I probably, if I met her in person, she's probably a nice lady, and I would probably have to apologize and stop making so much fun of her.
Yeah.
But we all know the game. You've seen this time and time again.
Well,
If you chase excess returns, you're gonna get bitten in the butt.
I don't know if you remember this, and I just laughed because the beginning chapters of Warren Buffett's autobiography go back to the 2000 tech bubble, and everybody else is saying, "Well, the old man, he's kind of lost his game." That silly Warren Buffett, and it's just like,
Been there,
here we
done
go.
that,
Here
did it
we go.
before you were born, still doing it. Yeah. There's no I'm a big fan of there are no certainties, there are only probabilities.
Mm.
I think I want to say that's Thomas Sowell, made pretty popular by George Gammon now. But I mean, many people say it, and the more it's funny, these old expressions, they become trite or cliche,
Yeah.
but by the same token, they are no less true.
Right.
They've held true for a long time. And this old expression, a bird in the hand is worth two in the bush. I think it's updated to a number in the cell phone is worth two written on the hand, or some millennial reference that I'm probably missing the update. But it is no less true. I mean, the pro formas like we see in real estate deals, I could care less. I mean, it's comical to me. Whether you're promising me 20, 25, 30%, really? That's what you're leading with? I mean, I find it just comical. I mean, as well as I do, anybody who's remotely friendly with math knows we can make a pro forma look whatever we want. And I'm not going to get into the minutia of taxes and the whole loan process and when things are credited or not credited or accruals. I know you can play every game you want with this. I have a master's in accounting. I don't really talk about that often. I've been there. I've done it. I graduated college, summa cum laude within accounting, in that bachelor's of science. I have a master's. I've done off-sheet balance accounting. I've seen the games GE plays, for example.
Oh,
We all
man.
knew where GE was going. They played, the accounting game for many years. They got away with it then until they didn't.
Right.
We know these games. What's going to make a real estate syndication successful? It's just like everything else in life. It's no different than venture capital. And people look at me kind of crazy. Andy, how is a boring apartment building the same as some acronym I can't spell that involves the intranet? We're like, no, it's the same thing. It's still investing. One might have cash flow, one might be more speculative, but it's the same thing. They look at me and they still don't get it. I said, what every VC is going to tell you that's worth their salt? They're going to tell you the list of priorities starts with the team, the team, the team, and then they'll get into whatever XYZ stuff. You talk to a mining speculator like a Rick Rule or a Jim Rogers, and you get them going, the very first thing they're going to be pounding on the team,
We like the
the
team.
team, the team. And then they'll get into, the other related issues. When you get to talk to most real estate people that have been doing it longer than 5 years, what are they going to pound? They're going to pound the team, the team, and the team. And the related point of the ability to execute the business plan.
That's right.
They're not going to talk about who's the best underwriter. Now, don't get me wrong. I'm not trying to belittle underwriting or it's important. Clearly, it matters. But the underwriting reflects the business plan.
Right.
If you cannot execute the business plan, I don't care about your pro forma.
Right. Well,
You
you are onto a great point, and this is one of the things I don't think, and I wish everyone. Okay, I don't know if I wish everyone would do this, but after you've had an econometrics class, you know that a forecast longer than a year, the error term goes parabolic, and the error term is greater than anything you forecast, and so it's like it's almost it's an exercise. I don't want to say it's not worth doing, but in a lot of ways, what does it really mean 2 and 3 years out? So really, you're onto a great point about that, and thank you so much for that first point about and love to talk to you about that today in terms of being an LP. How do you look at deals? And I think we're onto the first key point that you're talking about is the team, the team, the team.
Yeah. Well, yeah. I mean, I'm going to go backtracking forward, but
Sure.
you have to have the humility to know you're not going to tear apart the underwriting for the most part. I mean, unless you're a CPA or you're already done many, many syndications, you're probably not going to tear apart the underwriting. But that's not an either or. It doesn't let you off the hook. You're going to look at rent projections. Like if they're doing 10% a year for the next 5 years, I'm out. I mean, that's pretty obvious. I know you would be too.
Yes.
You're going to look
Not
at just
gonna happen.
you're just going to spot check the obvious stuff. Like taxes. If you don't see a big bump in taxes, you're like, wait, you've improved the property. Clearly, taxes are going to go up. If you're in South Florida, let's just say,
Right.
Insurance probably going to go up, right? I'm not saying don't invest. I'm just saying, you should be having this discussion. So these are the things, but it all goes like back to what you're saying is the team. If they've done this before in that market, in that asset class, and they're telling you something that's pushing your spot check, it has validity. If it's a first-time operator who's never done this before, I'm out. I'm not even having this. I'm not even going to have, I'll be honest with you, I'm not even having the discussion. It's just done. We're not having this discussion. Whereas a more seasoned operator specifically, and it has to be specifically in that market, in that asset class, then we'll have the discussion. What bothers me is, if a guy says, hey, I've always been successful in Dallas. I've done A class, but we're doing a deal in Little Rock, Arkansas in a C class building. Okay, we're on the fence here a little bit. Then if there's any issue within the underwriting, now we got a real problem.
Right.
There's no reason for me to have a basis of belief because it's a different asset class in a different market that you've not done. I now have to believe you're relying on some broker or co-star. You don't know the numbers. And that this is kind of a tangential point, and hopefully co-star doesn't sue me or slap a restraining order on me. But I could care less what co-star has to say. I mean, even worse, obviously, none of us give two rips what Zillow, Redfin, Trulia, or a bunch of software engineers who don't realize how arrogant they are, the level of their hubris. If I want to know what a rent is going to be in Buffalo, New York, let's just say, for instance, I'd much rather talk to Eric Charlton and his partner that own buildings there. And I want to know, do you own a building within 3 blocks of the same category? And when he tells me, Andy, there's no way that building's renting for 900. I own the nicest building on that block. We're getting 750. Then I know that that's just a baloney number. I'm trying really hard not to swear here. I almost lost it there.
No, the word bovine excrement and bullshit are allowed on this podcast.
Okay, well, you know where I'm going with this.
Yes, absolutely.
Yeah. So the experience and time in a market can't be understated. you know, there has to be some element of a check of the numbers, the due diligence. Due diligence isn't hiring somebody to do due diligence for you. Due diligence isn't walking the property once. It goes way beyond, way beyond that. I want people that there's someone on the team with boots on the ground in that market. They've been doing this for a while. They have real skin in the game. They own buildings in that market. Their bullshit detector is going to be a lot higher than just some guy doing remote investing. I'm a remote investor. I own properties outside of Hawaii. I own them in multiple states. I don't want to invest in a multifamily deal with, frankly, another remote investor. I might as well just do it myself at that point. I'm gonna give you an acquisition fee. I'm gonna pay you an asset management fee to be, frankly, delinquent, to be an absentee owner, to be so dependent upon your property manager, dependent upon a broker. Oh wow, you flew up and spent a weekend there. Sorry, that just doesn't interest me. Like I might as well do that with you, Douglas. We might as well start
Right.
a JV and just
Let's
do it
do it.
ourselves. Why am I hiring
Right.
you?
Right.
You know? So like, our mutual friend Angel Williams, or a George Roberts or a Brian Briscoe, when they present a deal, they've done this before. It's measured in many years, many, many projects. These are the kind of people that, I'm gonna want to at least listen to the deal. I might not always invest, or I might not like every deal, but they're at least gonna clear through the sniff detector of, okay, I want to at least listen to the deal.
And now that and I want to follow you on that track, I'm very curious. Do you have any stories that were a bad LP experience that you learned from that we can share for folks, that we can say, okay, this experience didn't work well, and here's why,
Yeah, and it,
without
it
naming
falls on
names?
it falls on me. Some of it falls
Yeah.
on the syndicator. My very first relationship, we became friendly, probably too much so. So I probably trusted the person more than I should. Now,
Mm,
granted, they did a lot of dotted deals,
mm,
decade of experience or more.
right.
And they types, dots all the I's, crosses all the T's. There was a voice in my heart saying, maybe there's too many deals.
Mm,
Maybe they can't properly do the due diligence on this many. Maybe they can't properly asset manage all these. Then, I start meeting other syndicators. I'm like, wait, they've got two people in essence really on their deals. Most people, at least three. You got to have one guy sourcing the deal, one guy raising the capital, and usually one person, I shouldn't say guy, woman or man,
mm,
doing the asset management. They only got two. Who's the asset manager?
mm,
Well, they were both doing asset management.
mm.
I should have known better. They went after a much larger asset. They kind of wanted to take on more challenge and go to the next level. And I was excited about joining them to the next level. And that's not thinking up here, that's thinking, feeling down here. The due diligence didn't go well. Um, the tenant role wasn't what we thought it would be. There is an element of whether or not the seller was fraudulent. Then you kind of come back with, well, you were the due diligence provider, you got the acquisition fee, you're still responsible. The deal went bad, has a capital call, and to make matters worse, I violated my own rule. Normally, I just do the minimum, and I like to do lots of minimums. On this particular deal, I did a lot more.
Mhm.
I was flush with cash. I have some personal biases against fiat, the US government, central banks, which we won't go into because, I don't want the FBI showing up at my house. But long story short, I invested much more than my normal amount. And I've done it twice. One deal does fine, one deal's a stinker. One stinker deal that's a wrong position size screws up my portfolio for many years.
Mhm.
Painful lesson. You move on, you learn from it, won't do that again. But it's fine. It's still relatively small within the scheme of a portfolio. I have to admit that my biggest suffering was my ego.
Mm,
And if you can't admit that, you're making a mistake. And I specifically, Tony Confliti is my friend.
mm.
He's a big time stock and futures trader, commodity trader.
He's
And people
incredible.
often ask, why would you guys be friends? You're a real estate guy. He's a stock guy. And I'm like, no, investing's investing. It's the
Yeah.
same It's all the same fundamental principles. And we had quite a long conversation about it. And in the reading list he provided me, we talked many times, and he was laughing, saying, "Yeah, you picked up exactly what the advice I would give you is the reason why you're pissed off isn't the money. You're pissed off because your ego was damaged."
Mm.
Then he said, "At least I'm proud of you because you're cognizant that of that, so at least you can manage it." And investor psyche, investor emotion, all these touchy feelings that we don't want to talk about or acknowledge, you're foolish if you don't think that that's not the most important thing. I mean, a calculator is great, a spreadsheet's great, but if you can't manage your emotions, if you can't have a historical perspective, a calmness about you, you will be taken advantage. It's not if you'll be taken, you will be taken advantage of. You will chase cryptos at the height. You will not buy at the bottom. When the market is hottest, that's when you will be buying because you will be a momentum buyer. You will talk a big game at the cocktail party, but when the GFC happens, you will not be paying cash and buying houses pennies on the dollar. Baloney. You're a big talk. Most people I've noticed are full of it. Big talkers don't back it up.
You
Okay,
know where
wow.
we're from, we call that all hat and no cattle.
Yeah, I mean, you bought yourself 20 shares of XYZ stock at the GFC low, and you're proud of yourself. Well, that's great. You put your money where your mouth is and everything. If you bought 5 properties and you bought them at, these ridiculously low interest rates, and you bought them when nobody was buying real estates, then great, come and brag to me. Not many people did it. Not many people will during the next down cycle. Let's call it for what it is.
Yeah.
For every doom and gloom forecaster, for every guy who says he's going to buy it on the high and sell on the low, I'm calling bullshit. And it's been called for a long time. Berard Baruch, I'm sure you've heard the expression, and I'm going to paraphrase, but he's basically saying any gentleman who's telling you that he always buys on the high and always buys on the low is a liar. It don't happen. It doesn't happen to Warren Buffett, who's the greatest single investor of all time, who he himself has had dog investments that have gone south. He's had mistakes.
Yeah.
So anybody's going to tell me at a cocktail party that they just always buy on the high and they're always selling the low, and they're driving a Subaru outside of their house, and they're still at a day job, I'm kind of like, okay,
Okay.
sure.
All right.
I gotta be polite and nod my head and keep,
cool.
but not bite, not say anything, because otherwise my wife's gonna smack me in the back of the head and kick me out of the party. Which, fortunately, my wife kicks me out of a lot of parties, and someone will say something, and
Like,
she doesn't even say anything anymore. I just get this, you out, and she kicks me out of the party, and I sit in the car and have to wait for her. That's life, but it's okay.
And Andrew, in terms of I feel like it's a kind of a missing piece in the real estate space, and I'd love for you to talk about that advantage. And this is something that I've added in the past 10 years when I was like, okay, out in the wilderness trying to figure out, okay, what do I do with my next direction here? Adding in the investing is investing mindset into real estate, because I don't really see it being that a common mindset, I don't think. And I'd love to hear your take on how has that been an advantage to you in what you've done.
Well, I think first off, one of the advantages of it is that it's just fun. It's more interesting. I mean, I don't have a huge gold holding. I can't please the gold bugs. No matter what I would say, because I'm going to have more of a balanced or tempered view, they're not going to like it. The stock guys aren't going to like that. I'm pro gold. I like gold. I like silver. I like mining companies. I only buy them when I find them attractive. I don't buy them every quarter. Years could go by, I might not buy them. Next year, I might buy a ton. Next year, I might sell. I don't know. I like that flexibility. When you follow gold, it starts bringing you down the rabbit hole of macroeconomics and history. Bretton Woods, the petrodollar system. Of all the asset type dogmatics, the gold bugs arguably are the most intelligent when it comes to history and how the world really works. The stock guys, and no, they're not going to like this, I would argue are the least intelligent, the least understanding of how the world works, and the least aware of political or a socioeconomic risk, jurisdictional risk. The stock market is a great investment. I own stocks. I'll own stocks for decades. I plan on my son inheriting these stocks. I'm not against the stock market. I've never understood why so many real estate investors constantly post on LinkedIn, stock market's down. See, I told you real estate is better. There is no better. There's different flavors.
Mm,
I go to Baskin Robbins. There's, what is it, 36? I forget.
yeah.
They got a bunch of flavors, you know? I want to be able to look at the whole arena of investments. Do I like crypto? Not particularly. I mean, I have a sundial strapped on
Yeah.
my wrist. That's how I would tell time. I'm no technologist. I don't like it, but I bought a couple little bit of it because, like you were talking earlier, you follow where your money is.
Right.
Even if it's only $500 or $1,000, you're going to follow where your money is. Now, crypto investors, interesting group of people, a lot of them neurotic, frankly insane, but there's a few really good ones. I've met some great ones. I actually met one at a real estate conference from Puerto Rico. Great guy. I won't mention his name because he probably likes to keep it on the down low, but he's done phenomenal in crypto. I mean, the guy's killing it. But he's at a real estate conference
Yeah.
because he knows it could boom, it could bust tomorrow.
Mhm.
It could be regulated out of existence for all he knows. And he's no dummy. He's very smart. And he's like, hey, I want to take a portion of it and put it in a boring asset that cash flows, get all the tax benefits because he's hearing about all the tax benefits. And he's like, I'm not, I don't want all my eggs in one basket. No matter how brilliant I am in this one category, he's not arrogant enough to believe that that's all he should do. And I'm missing other asset classes like, farmland. I own a little bit of a stake in farmland, and people think I'm nuts.
Mm.
Farmland's returns, which they forget to tell you, if you do it over a long enough period of time, if you're going to do stocks, bonds, gold, oil, farmland, lo and behold, guess what is the highest yielding asset? It would be farmland. Now, is it going to be on a quarterly basis? No. A yearly basis? Certainly not. Even on a decade, I don't know. But the little bit of that portfolio, that's money I'm never touching. That's going to my son. Then the other thing is, do you know farmland? I don't know farmland well, but the specific farmland that I'm interested in, it's the same thing as multifamily. And I had this conversation with someone who looked at me like, huh? How could farmland be the same thing as value add multifamily? And I said, well, do you think all farmland is the same? You just buy the land and you don't touch it, you don't do anything with it? And she said, oh, okay, well, tell me more. And I said, well, do you think traditional farmland that uses pesticides and fertilizers is valued price per acre the same as organic farmland? She thought about it and said, no, that wouldn't make sense. Clearly, it would be worth a lot more because you go to the store and you buy avocados and you buy organic and you buy traditional, there's a price difference. So clearly that land then would have more value. So I said, there's the logical leap from multifamily value add to value add farmland. The farmland I'm interested in investing in is organic conversion. They're taking traditional land and they're converting it to organic. It takes a while. You need investors to do it. When that time changes, the cap rate is now different for the same amount of land. Also, there's some nice benefits. When fertilizer prices shot up, organic farmers that are using manure were really benefiting because their cost basis is actually cheaper than their traditional counterparts. But that's why I'm saying, like, to try to think that like only one investment asset class is the best, is foolish. There's nothing in life is the best. Which martial art is the best? There's no best martial art. That's ridiculous. I mean, there is no martial art according to Bruce Lee, right?
Yes.
Jeet Kune Do. Jeet Kune Do
Be water.
I'll steal from
Yes.
judo. I'll steal from karate. I'll steal from taekwondo.
Believe it or not, I studied Jeet Kune Do for a while.
All right, and up comes MMA, which is a sport, but I mean, it's a very easy way to transition your thought imperfectly. To me, Jeet Kune Do is no different than investing. You're going to take the best of all the asset classes when they're cheap, which they're not always cheap at the same time. You could argue the everything bubble, everything's screwed up, but over a longer period of time, as well as I do, the cycles change. there's going to be a time where I'm not going to be interested in real estate, can't buy it. The valuations are terrible. In that time period, gold could be cheap. I might buy gold. During that time period, maybe bonds are attractive again, which let's make fun of bond people for right now. And I'm giving them a compliment though.
Yeah.
The smartest investors are the bond investors. Let's call it what it is. When I worked in private equity, everybody knew the smartest guys were the bond guys. So the guys that everyone wanted to talk to in the equity room were the convertible bond guys. Because the convertible bond guys were talking to the bond guys, and we know they're the smartest guys.
Yeah.
Why do we care about yield curve inversion? It's very obvious that the 2-year treasury should not be higher than the 10-year treasury. It does not make conceptual sense.
Right.
Why would I forego consumption for a lower rate of return over a longer period of time? It does not make sense. It can only make sense if we do not believe the Fed, if we believe recession's coming, and then the next logical step being lowering rates to combat a recession. So what is the smart money? The smart money is the Eurodollar futures. That curve inverted first. The next curve to invert would be the bond curve. That's the smart money. Now, there's my compliment to them. Now we'll get to the part where I make fun of them. I mean, what is a bond currently? To me, it's return-free risk. It's the one time in my life, and this is all paraphrasing, these are not original ideas. This is Jim Grant and several other more brilliant men. But it's the one time in my life where the government will keep its promise. They do solemnly swear that they will pay me back less money than I gave them in future inflated fiat currency. Lovely promise, no thanks. The nation with the greatest debt in the world, setting the world record for debt, 31 trillion on balance sheet items. Not the best credit person I want, not the best credit quality. And then you're going to give me 4% during a 9% inflationary world if we believe CPI, which we won't get into, Douglas. That'd be a separate podcast,
Right.
that.
For sure.
And then the other one is we're going to call it certificates of confiscation. Really, why would I want a bond? Unless I'm going to play the game of interest rates and I'm going to trade it, then it's a speculative asset. But as an investment, no. The 60-40 lie, we've made fun of the 60-40 lie for how long? The 60-40 lie is not working. I mean, I don't know, call the British pension funds and their LDIs and see how that went.
Yeah.
No, I really like real estate. I like to have the option of real estate professional status, though I don't use it. I would like to do cost seg studies. I really like bonus depreciation and depreciation. I really like borrowing money to buy real estate and being able to write off the interest. And the tenant is paying my mortgage. I don't know. These are very attractive things. Theoretically, all asset classes would be created relatively equal, but they're not. We don't live in a theoretical world. We live in a world where the government creates a tax structure that favors certain asset classes over others, for better or good. Without being a conspiracy theorist, you could make the argument, why would I offer tax incentives to gold? We dig it out of the ground and then we put it in a vault. Now, granted, there are some industrial uses for it, but you get the idea.
Yeah.
Whereas housing, clearly we need houses and we need hospitals and we need quickie marts, gas stations, and we need universities. So you could make the argument that there's reasons why real estate would deserve its tax status. Not that I agree with it personally, but you can make that argument and you can have that discussion. But yeah, so the world isn't a level playing field. So the most tax advantaged, the most tax favored, the most tax friendly asset class is real estate. If you don't want to play in that sandbox for whatever biased reason you might have, it does come across rather odd. Now, I'm not saying to be a maximalist. I'm not saying I would want my entire net worth only in real estate. It's fun for me to say that this asset class has just tremendous unfair advantages thanks to the government. Does not mean I'm saying it's the only investment. I mean, that conflation is just absurd.
I'd be interested. There is one thing, and I do lean heavily to real estate, but I'm also with you. Like, I don't want to completely ignore. If you're good at derivative trading, you can do quite well, but it's a very technical skill, and you better have your A game because you got PhD with physics on the other side. trading against you. So I would be fascinated with your take on um, the relative skill levels of each different market. So let's say in equities, I do believe it's a lot harder to be good at from a behavioral standpoint at equities versus real estate. You don't. It's a lot easier to be successful at it. I believe overall.
Oh, very much so. When I have a lot of friends in other fields of investment, much smarter than me. And I always laugh and tell them that's why I'm where I am.
Right.
Because I'm going to take the most tax favored asset class that frankly is pushing stupid proof. And I'm going to do that because I'm very well in charge of my own ego. I know my place in the world. I'm not the smartest cat in the room. I've been in enough rooms. It's fine. If anything, like Douglas, the old advice: if you're the smartest guy in the room, get to a
Better
better
get in a
room.
different room. Yep.
I
Yep.
love not being the smartest guy in the room. It's
Right.
wonderful. It's a bonus. It's an asset. Um, that being said, there's something for. I've always done well in real estate. I haven't done great. I've always done well. I've had 100%, 200% stocks. I've also lost money on stocks. I don't know. It's also depending on your lifestyle. Like I drive a Honda. My wife drives a Honda. She shops at Ross. She won't buy the blouse if it's $9. She's like, it's
Yeah.
usually 7. I'll wait till next month. We do well. We run a family business, but material wealth has never been a big driver in any of my family's life. My parents, nor both sets of grandparents. Money was something that provided you optionality. It ensured your freedom. It gave you liquidity. It allowed you to take advantage of versus be taken advantage of, these types of things. But it was never about fancy cars, fancy watches, fancy clothes, which I'm not trying to belittle anyone who does that. I always have to make this caveat. That's fine. Like that's your money. Whatever makes you
Right.
happy. For
Right.
me, I'm just saying personally for me, it's never been a driver. I mean, I'm wearing a shirt from Costco.
Right.
You know, that's just not for me. I get excited, and drive my family nuts because I want to talk about Amy Silvas's Flex Industrial deal that I just invested with on Friday. That
Huge.
excites me to
Yeah.
no end.
Yeah.
I'm thrilled. My son is just like, oh God, I have the most boring father on earth. And I'm like, you little jerk, you're gonna inherit all this. So you be a little more appreciative. You
Could you
seem to
be a
like
little more?
yeah, it's like you like shiny stuff.
That's
Maybe
right.
maybe you might want to learn how to get the shiny stuff versus
Right.
just liking the shiny stuff.
That's right.
He's a good boy though. He just
Yeah.
likes to rip on his father a lot. I wonder where he would get that from, right?
Yeah, as boys are wont to do, right?
He couldn't have possibly inherited that from one of his
Could
parents, right?
couldn't be.
Oh,
Couldn't.
yeah. I mean, that's so for me when I'm looking at these things, I'm measuring things in decades, where I probably should be looking more generationally, but we're not quite there yet in terms of an absolute number, perhaps. But even then, like for my wife and I, we don't have big aspirations. Like I'm not looking to buy a mansion. When that's what gets you in trouble too, frankly.
Yeah.
When you talk to stock traders, they will tell you to a person across the board that every one of them, and the more successful they are, the more adamant they will double down on this statement. That if you're looking at any investment, any transaction as if this doubles, I'll buy a Porsche, or I have to make X% to retire in so many years, or if I make this, then I can buy the yacht or the boat or the house, whatever. If you're putting a material good as the justification or the reasoning for the investment, I can't explain why, but I will just tell you it will go bad. You will make the wrong mistakes. And I say mistakes, not mistake. You will make multiple mistakes. It will go bad. As soon as you start thinking in terms of material goods and how the dollars or the numbers work, it will go south. The Reminiscence of a Stock Market Operator
Yeah.
by Edwin Lefevre.
Yep.
It's there's nuggets throughout the book but it's a theme he constantly pounds into the reader's head is that the frequency of any time he had a bad trade, it's when his mind wasn't right, his
Mm.
psyche wasn't right, his emotion wasn't right. And it was owing people money in some instances, or when he was thinking of, oh, well, if I make this much, I'll buy a yacht. Then the investment got screwed up. When he was able to detach himself in a limited capacity as a human, you can detach yourself within reason. That's when you think clearly. That's when you make good choices. And you make the choices that are good for your circumstance. You
It,
know, a
it's
20-year-old, I can't give the same advice. Someone says, well, what should I invest in now? What's the best investment? I can't answer that question, nor can you honestly.
mm,
I can't tell a 20-year-old the same answer as a 60-year-old.
yeah.
I can't tell a software engineer who maybe should be investing in crypto because they're a techie. I can't give them the same answer.
No.
If you're a corporate finance guy, then by all means, maybe you should be doing, private equity, or you should be doing real estate, stocks, or bonds. You have a math background.
Yeah,
I can't.
I'm from the Church of Munger, and you should see Charlie Rip on crypto. So we just die. I
Oh,
cringe every time I hear the word crypto. Even I'm like,
no,
oh.
no, but I mean,
But you're right though. It's for to each their own. Also though.
yeah, if that's a big if you had some compelling durable advantage in whatever it is, then by all means, your focus should be there.
Yep.
The interesting thing though is most of those people also own real estate.
Right.
Most of those people will spend the time and control their ego and find a good hedge fund manager, find a good mutual fund manager, find a good whatever, or like they'll find a good syndicator to do real estate. They'll find people within their network. Successful people seem to gravitate towards each other,
Mhm.
and they're not always within the same industry. You're
Right.
going to see a lunch where there's a successful real estate developer and he's meeting with his friend who's killing it in the stock market. They're going to trade information.
Mhm.
The stock guy's going to tell him, hey, these are the guys you should be investing with. They're going to tell you, hey, don't invest with this guy, or don't invest in this market. How many people in life really do well by completely dogmatically focusing on one thing, and that one thing isn't going to crash at some point in their life? I don't know. I find it funny. Diversification is a tough thing.
Yeah.
Real estate, is all real estate the same? Yes and no. When people say, what do you mean yes and no? If you're copping out, it depends is a cop out. No, it depends is being honest.
Mhm.
Depend is being honest with life. I don't know what the world's going to do. Is industrial going to go down at the same time as residential? Maybe. I don't know.
But
But
possible.
they tend to kind of go in different paths.
Mm.
So I'm gonna invest in both, but I'm not gonna have the delusion that there's a certainty that this limited correlation is always going to apply. I mean, the everything bubble is called the everything bubble for a reason. It's going to be everything, right? When there's a credit crisis or a liquidity crunch, people sell everything in the short term. In the long term, Douglas, right? Things go back to normal.
Right.
So that's kind of where I would go with this. Like, this idea of being dogmatic about best or one asset class is incredibly foolish, particularly because most of the people that espouse it are not that skillful to be even considered to have such a durable advantage that they would be the exception. And even those with the exception generally don't do it.
Mm.
So, I mean, if you're 1% of 1% of 1%, then, hats off to you. I'll pat you on the back. You're awesome. I think the odds stack pretty much against you that that's you.
I'm gonna have to say that's probably the mic drop moment. And Andrew, I want to thank you so much for joining us today. And your experiences in LP and in managing risk and investing generally are fantastic. Just to recap, Andrew, the top books, if we were going to recommend Against the Gods, Reminiscence of a Stock Operator, When Genius Failed. I don't think we mentioned that one, but I
That's
cannot
a good
recommend
one.
that one. Cannot recommend that one higher. Any other risk related books that we haven't talked about that we should have?
If you enjoy trading, or you can see how trading can still be applicable to other investments, the Jack Schwaggart series, Market Wizard series, is a
Market
great
Wizards.
series. the very first one. Now it's dated, it's from
Yeah.
a different time, but it'll open you up to some pretty good speakers. And I'm reading actually the second book in it that's a little more contemporaneous. But yeah, those are some good. And really the one everyone should be reading that most people have read, but you got to read Rich Dad Poor Dad.
Yeah.
I'm not a Robert Kiyosaki fan. I hope he never sees one of my videos ever. I don't
Yeah.
particularly care for the guy
Yeah.
so far. I mean, maybe I'll meet him in real life and it'll be different. I don't particularly like almost anything that comes out of his mouth in YouTube, but you cannot take away his impact. The
Right.
single most influential personal finance investing mindset, name a term.
Yeah.
You can't take that away from the guy. That book is the seminal book. It is just an amazing book.
Yeah.
So yeah, that would be the one caveat. It's just that's the book you got to read if you
I
have.
have to agree, and in fact, I have the same exact take. So if he sues either one of us, he'll have to sue us both. But I do
Yeah,
agree.
go after Douglas. He's got bigger pockets.
Yeah, biggerpockets.com.
No, go after
Love it.
Douglas, not me.
Oh, that's right. Go after me. Come at me, bro. Come at me, bro.
Well, also you got the law.
Yeah.
You got the law.
I
degree,
can
so.
I can lawsuits don't intimidate me as they do normal people. I would agree with that.
I appreciate your sense of humor, Douglas.
Absolutely.
Thanks for having me on.
Yeah, thank you so much, Andrew. I really appreciate
Yeah.
it. And you really your depth of and breadth of experience is hopefully educational, and hopefully real estate syndicators that see this open their eyes to the portfolio view more. And so what I'm hoping to see happen with this podcast is understanding the entire portfolio of what an investor is looking at, so they know, so more about what the person on the other side of the table is facing. So thank you so much for opening up that worldview of what an LP goes through, and limited partners have a lot of choices in how we can best serve the limited partners in the world. And thank you so much for sharing your experience with us.
Thank you, Douglas. I appreciate it, and
You
I
bet.
really appreciate our friendship. Thanks, buddy.
Absolutely, same here, and I look forward to talking to you soon.
Thank you.